This isn't good. Philadelphia-based Republic First Bank is the first FDIC-insured bank to collapse in 2024. This bank had $6 billion of assets under management and $4 billion of consumer deposits. Pennsylvania regulators stepped in and seized this bank on Friday the 26th after a failed deal earlier this year to bring in new funds for the bank, because they're struggling, to say the least. Welcome to the channel, guys. I hope you stick around. I'm sure you'll find some good value in these videos. Now let's go over how and why Republic First Bank collapsed. Norcross Bracket Group is an investment firm that expressed interest in investing $35 million into this bank, but they backed out of the deal in early February when Republic First failed to hold its shareholder meeting, stating that they would reschedule the meeting to November 2023 because it more aligned with when this deal would occur. But prior to this collapse, Republic First Bank was delisted from the NASDAQ stock market because it failed to submit its 2022 fiscal year reports to the Securities and Exchange Commission. The bank claimed that they failed to file this report because their former executive team's failure to maintain adequate internal controls. But there was more to it. Now, this is the fourth bank getting seized by federal or state regulators since the start of 2023, following the failure of Signature Bank, Silicon Valley Bank, and First Republic Bank, which were the biggest bank failures since the 2008 financial crisis. And that is not a good sign. And although these prior bank collapses were a lot bigger than the current Republic First Bank collapse, and they were a lot more specialized banks, it doesn't help the public's view on the current state of our economy when they see headlines of multiple banks collapsing over the span of 16 months. After being seized, regulators had to find a potential buyer, and they found one. Former competitor Fulton Bank reached an agreement to acquire all 32 branches of Republic First Bank, spanning across New York, New Jersey, and Pennsylvania, all of which will reopen under the Fulton Bank name. The reason for this collapse was a large decline in deposits and a failed mortgage lending business, pointing the finger at a high interest rate environment. But bad management played a significant role in this. The company's plan was to wind down and exit the mortgage lending business and start focusing more on consumer deposits. And considering as of June 2023, 60% of Republic First's $4 billion in deposits were insured, not only taking a lot of risk for themselves, but with their clients' money too. Now, it's worth noting that all the money and assets that were under this bank were secured and insured, but that's still a little too close for comfort, and I'd have to imagine that a lot of the people that use this bank were terrified. Republic First said in a regulatory filing that their plan was designed to work without the Norcross Bracket deal. But clearly, that didn't go as planned. So is this the start of a major banking collapse? Should we all just buy Bitcoin? Well, in 2020, the Federal Reserve reduced the reserve requirements of banks down to 0%, meaning that any money that you deposited into the bank didn't have to hold a single penny of it. They were able to take that money and write as many loans as they wanted to, and the reason for this was due to the pandemic. They were trying to stimulate the economy and keep everything flowing. The issue with that is the banks had no reserve to fall back on, and they knew that they would eventually have to dig themselves out of this hole. But after the Silicon Valley and Signature Bank collapse in 2023, the Bank Term Funding Program was created. And this was created in March of that year, which was an emergency lending program created by the Federal Reserve to provide emergency liquidity to banks to avoid any more bank collapses. And well, they had to use $161 billion of it just to stay afloat, and that program ended last month on March 11th, leaving banks with only 1 year to pay back that $161 billion in a balloon payment, which obviously created a pretty significant problem. How are banks supposed to pay back all these loans with liquid money that they don't have? That's the real question. The FDIC is the Federal Deposit Insurance Corporation, and up to $250,000 of your money per depositor is insured. So you would think your money would be safe. And well, pickles are great until you're in one. And our banking system is in one. In the last quarter of 2023, the FDIC insurance fund stood at $121.8 billion. And that's a lot of protected money. But the United States banking industry has $17.4 trillion in deposits. To put that into perspective, the FDIC currently has around 0.7% of the money it actually needs to insure all deposits. The banks have to provide the rest of the stability themselves. Considering less than 1% of people are depositing over $250,000, it makes you question, when you make a deposit, how much of that deposit is actually insured. And things aren't looking good. Interest rates are high and they're going to continue to stay higher than most people thought, putting more pressure and weight on the economy as a whole. 4 banks have already collapsed in 16 months. The FDIC says that there will be only one bank collapse in 2024, and that is Republic First Bank. But according to a social science research network, 186 banks are currently at risk for failure. And it's all due to rising interest rates and a high proportion of uninsured deposits. That's a pickle for sure. Now, in an average economy, it is normal for a couple banks to go under every year, but I think it's safe to say that we are not in a normal economy and we're struggling at best. Ironically, Bitcoin has been going up since the start of these bank failures. Is America losing faith in our banking system? Bitcoin would be a strong indication of this. But unfortunately, only time will tell how deep of a hole we're currently in, and hopefully by then, it's not too late. I hope this information and perspective helped. If you did find this video useful or informative, I'd appreciate it greatly if you gave it a like and subscribed. It's rough in this economy, okay? Try to stay afloat, and I'll see you in the next one.